In this session, I want to introduce you to a relatively new product in the marketplace, which we call the tax-free savings account, or commonly known as a TFSA, so tax-free savings account. You say it's relatively new, and it's been around probably, maybe 6 years, 7 years tops, whatever, okay? So first of all, in a TFSA, the contributions are not deductible, okay? So if you put money into a TFSA, unlike putting money into an RSP, where you can deduct the premium, here, your deposits are not deductible, okay? However, the accumulation, even though they're not deductible, the accumulation is in fact tax-free. So whatever it is that you decided to put your money into, be it interest-bearing notes, capital gain products, dividend-different products, whatever that happens to be, whatever that growth happens to be, you're not going to get a T3 or T5 at the end of the year. So the amount of money that's accumulating will be in fact tax-free. The real interesting thing is that when you make a withdrawal, it's also tax-free. So here, not only do we have a tax deferral, you might say, but at the other end, you actually don't have any tax at all. So it's a very, very good plan for long-term savings and everything else, where you're taking away sort of taxable money and put it into taxable, non-taxable type product, such as a TFSA. So all your withdrawals are going to be tax-free. Anybody can open up, an adult can open up a tax-free savings account, but must be 18 or over. Okay, so basically you have to be at age of majority to open up one of these accounts. It could be any time, as long as you're 18 or over, you can open up the TFSA. The annual maximum is $5,500. So there is a limit to the amount of money that you can actually put in here. So the annual maximum is $5,500. Okay. The nice thing about this is that if you, let's say, for argument's sake, this year you're not able to make that $5,500, or you were only able to make $1,000, or maybe none, whatever it is, whatever room that you didn't use that particular year, you don't lose it. In other words, you can carry it forward into the following year. So for those, for example, particularly younger people who don't have necessarily the resources at that point because they're paying for tuition fees, or they're trying to buy a house, or whatever the case may be, they don't have the resources and everything else, so they can't buy a TFSA, but they have opened one up, and they have not made any of all the contributions or whatever it is. They can, in fact, one day, when they do have those resources, basically catch up on all that. So you don't lose. So if you remember with an RSP, you had all those carry forwards as well. We got the same situation here. If you're not able to actually make any contributions that particular year, not to worry, you don't lose those provisions. You simply carry forward into the following year, and so on and so forth. And unlike age 71, where you have to catch up on all these carry forwards, otherwise you lose them, in this case here, you can carry them on for as long as you want, because there is no age 71 here. Okay, this is not an age 71 situation. This is, you can keep this money basically tax deferred, you might say, but until the day you die, if that's your choice. So there's no limit to the length of time here. There's no cutoff point or whatever it is. But there is that carry forward. However, if you make an over contribution, there is a 1% penalty for every month that you make that over contribution. So if you put in more money, say by mistake you put in $6,000, that $500 will be a penalty on it until you actually make that withdrawal. So you have to be very careful as to the limits that you're actually using here. One thing that's very important to remember about here, and where sometimes people get themselves in trouble with the over contribution, is, let's say, for argument's sake, that here we are in September, and you decide that you need $2,000 or whatever it is. So you decide, okay, I'm going to take my $2,000 out right now because I need it for whatever purpose. And before the end of the year, you decide to put it all back in again. There's the problem with the over-contribution, you see. It's because you took the money out before the end of the year, you put it all back again, it is considered new money. Okay, so that money going back in again will be considered new money. So as a result, now you have a $2,000 over-contribution. So if you did that in September, let's say you took that $2,000 out, you left it alone, and in January 1st, in other words, the following year, you put in your $2,000 plus the new $5,500 for the following year, not a problem, okay? because it is in the following year. In other words, the carry forwards have to be for the following year. You cannot take out money now and then within the same year put it all back again. That will be considered an over-contribution, and you will be penalized at a rate of 1%. So moral of the story basically is if you're taking out money now, wait till the new year in January, let's say, put in all that money back in again, because that's your carry forward. You put all that money, and on top of that, you can put in that particular year's new contribution, let's say, and you won't have a 1% penalty. But if you put the money in by December 31st of the same year, you make that withdrawal, that is considered over-contribution, and therefore you will be penalized. Okay, so strongly recommend watch very carefully when you're doing that kind of thing there, because you could be defeating the purpose of why you're doing this in the first place. And we shall leave it at that, and we'll see you next time.